Hey everybody, this is Matt Bivons, CEO of Canopy. Welcome to the first of our Fireside Chat series with leaders in the business finance space. Today, I'm here with my friend Aleks Flom, who led the go-to-market strategy for several successful early stage and late stage fintechs like Flexport, Settle, and SmartBiz. Aleks, can you kick it off by telling us a little bit about yourself?
Absolutely. It's good to join you, Matt. I'm excited to chat. A little bit of background on me. So started my career in traditional commercial finance, spent 8 years at a little known bank called Wells Fargo in business banking, commercial banking, selling pretty much every financial product they had under the sun in the corporate bank and loved it, but wanted to be a part of the innovation ecosystem. And being in San Francisco, you really can't throw a rock without hitting a fintech that's doing something interesting and innovating. And so eventually jumped into the world of fintech and joined my first early stage startup, which was actually SmartBiz. It was a big culture shock going from Wells Fargo to a 15-person startup, but it's a good learning. And then really never looked back, spent time at great companies like Flexport, helping launch and build out and grow their in-house trade finance business, Flexport Capital, and spent a little bit of time also on the crypto side at Ripple, working on a lending product that they were contemplating, and then led the revenue organization at Settle as we were growing the business. Did some advising, and then most recently spent some time at a factoring fintech called FundThrough, which is based out of Canada. So been in the fintech space for the last 10 years and in commercial lending, commercial finance for better half of almost 2 decades at this point.
Very cool. So you've had the full spectrum. We call it the omakase of fintech in some ways. Want to double click on a few areas that I think are close to your heart and certainly to Canopy, which is lending in the context of embedding those services to non-bank or non-fintechs, right? Potentially vertical SaaS. So to set the stage for this conversation, what does embedded lending actually mean to you? And then second part of the question is, what do you think the future looks like there?
Yeah. So in my mind, and I'm a big proponent of embedded lending. I believe it's truly the future, and I think some of my career choices have, for the most part, reflected that. But to me, it's really meeting the customer where they're at. If you're a trade finance business, being really in the flow of the trade or in the flow of the payment. If you're an equipment financing business, being in the purchasing experience or in the financing experience as somebody's picking up a piece of equipment or looking to refinance or get cash out. And so really being a part of the experience or even the workflow for the customer, if they're running payroll or managing logistics, you're a part of that experience. You're not a standalone product. You're not a standalone platform that becomes an afterthought. You're really part of that entire operating motion that they have to live and breathe every day to actually run a core part of their business.
And would you say that, and this goes a little bit to the second part of the future of it, and I agree with everything you just said. I think this, we very much believe that every company eventually gets into lending and every loan starts at servicing. And when we say servicing, it's really about how companies account for their users making payments. So if you have users that are making payments, you have to account for those users. That is servicing. DoorDash services you, Uber services you. When you layer in financial products, there's obviously a lot of complexity around risk, fraud, all of the underwriting, the rules and policies that govern those programs. So the ecosystem to become an embedded lender requires a lot of inputs. As you think about this moving into the future, would you say that this is a specialty that companies will develop in-house, or will they partner with companies like Paraffin, as an example, to really handle all of those components and really outsource it, which might be a faster go-to-market, but therefore you're not taking part in the upside of the economics?
That's a great question. I think certain companies will ultimately keep it and build it in-house. And I think it's going to really depend on a couple of factors coming from personal experience. Really based on the ability and the sophistication and the resources of the company. If they're further along and they can make the investment and really do a good job and navigate the complexities, because everybody wants to get into lending. And then as soon as you start, you realize how hard lending actually is. And if you have no experience and no resources to really put behind it, you're going to start running into a lot of almost insurmountable challenges. I think the other factor that really drives that decision for folks is the size of their customers and the potential revenue opportunity, and the revenue opportunity, or the relationship they have with their core customers. If they're more of a really kind of super long tail SMB, almost micro business focused provider, chances are they're naturally having a lot of churn. A lot of those relationships are not super sticky, or at least not managed, and don't have a material revenue impact for their core business if they increase churn by 10, 20, 50, 100 basis points or 200 basis points because they layered on this complex product that is a little bit different and might impact the customer experience. If you have larger revenue dollars on a per customer basis and a more sophisticated core offering, chances are you're going to want to build this in house, or at least very closely manage it and not really outsource everything. Maybe just outsource the infrastructure, but manage everything from customer relationship to the underwriting model and everything in between in house, so that you're not relinquishing that control, right? Because if you start having negative customer implications, or bad taste in a customer's mouth because of churn or adverse credit decisions, you start losing good customers from the core business. You're literally doing the opposite thing that you set out to do, and it could start to have real world impact from a revenue perspective.
So I love that description, and it makes me think about one of your alma maters in Flexport, which is also a Canopy company. We love them a lot. So here's a very deliberate plug to Flexport Capital. But if you think about a company like Flexport, or any of the other ones that you've worked with, where lending is not core to their DNA from the founding principles. Obviously, now Flexport Capital is a large portion of Flexport's revenue stream, but thinking about supply chain management and then layering on lending, there might be some natural friction there, as many of the people inside the organization, as you mentioned, don't come from that world. And so if you think about getting a program off the ground, you need to have some defaults. You need to have some delinquencies. People think that having zero delinquencies is a good thing, and it's actually the opposite of that. You need to test the boundaries of your credit box, and you actually need to see where your customers are going to season to understand the actual risk profile. So with that being true, companies need to have some amount of defaults. With the previous comment you mentioned around that could negatively impact the core product or business, those two things seem a little bit at odds with each other. Can you talk through how to navigate that friction internally?
Yeah, 100%. So to your point, I 100% agree. I think in lending, you have to see defaults. You have to see what the downside scenarios look like, because you ultimately have to learn. And if you don't have any of those, you've either solved the centuries old problem of being the perfect lender, which I don't necessarily know is a real thing, or you're potentially leaving revenue on the table and not really taking the right amount of risk. Even the best lenders out there, the most at scale, they have defaults. It's part of the business, and you can't shy away from it. In my mind, really where the customer relationship aspect starts to come into play is when you're managing ongoing relationships and you start to see potentially a negative turn in the business, or you're changing your own credit model and have to have tough conversations with customers about their credit facility, the overall relationship, and managing risk. That is really what, at least from my experience, starts to have implications on the broader relationship, and customers saying, hey, I got a bundled deal. I work with the core business, I work with the lending business, you're reducing my line or raising my rate or doing something. And while I understand that it's probably a result of some financial change, I'm a valued customer. And so I start to think about my whole business relationship versus kind of these pieces of the bundle. And that's really where you have to navigate a lot of the complexity and a lot of the nuance and be tactful about it and not transactional and make sometimes tough business decisions of, hey, we're gonna own this risk because this is a great customer and we're hoping that they right size the business or come out of whatever issues they have, or we have to cut ties or stick with the credit model and really trust ourselves and deal with the other side of the spectrum. So I think there's definitely nuance and sophistication that comes into play here, but yeah, 100%. You need to push the boundaries of risk where you can.
And I think what makes us really special for fintech and people that are getting into embedded lending is that a lot of these organizations are product led. And so they might have a unique data advantage because they're seeing all the invoices. These are their existing customers. So the risk is different than a single transactional risk that a bank may see when they're underwriting an individual at a moment in time. A lot of these technology businesses are actually seeing data on an ongoing basis. So that helps them make better decisions. And as a product-led organization, they think about multiple products. So maybe an invoice financing product is not right for this customer segment, but an AR financing product is. And so having a product-led first principles point of view, I think also helps a lot of these companies differentiate and achieve success. And so I'd love to pick your brain about what goes into the go-to-market motion of these embedded finance products in a world where most of these companies are product-led. And so you've been head of revenue for several heavy product engineering technology organizations. And so how do you make sure that the go-to-market motion is rowing in the same direction as the product motion? A very tactical example is you may not be able to sell to a certain customer segment until a particular financial product construct is developed. And the product engineering team might say, well, I'm not building this before we have achieved significant demand or really understand the actual problem. And so a little bit of chicken and the egg. Would love for you to talk through how you navigate those conversations internally.
Absolutely. I think once you build up a little bit of momentum, you really need to make sure that you have a very, very tight feedback loop, both quantitatively and qualitatively with product and credit so that you understand where the bounds from a risk perspective are and what the product experience needs to look like to really optimize what you're trying to do. The massive benefits of being embedded, right? Is you're differentiated based on the data set and being able to make more unique, more sophisticated credit decisions than a standalone lender, to your point, like a bank, would be able to make at a point in time based on really just traditional underwriting parameters. At Flexport, it could look something like looking at historical trade data or even getting down to SKU levels and supplier levels because all of that information is part of their core logistics workflow. And so you can really take more pinpointed, more sophisticated, unique risk based on that data. But really backing up, especially in the early stages, a lot of it is grit and hacking together a lot of the go-to-market assumptions and putting together a test and being able to measure and saying, hey, we talked to 50 customers in this segment about this product structure. 45 of them loved it and were screaming to get access. And based on the risk model, 35 of those 45 would have gotten approved, or at least would have been looking like a strong approval. There's some early signal. Maybe it's not firm product market fit, but at least you have clear signal. Or the inverse, you talk to 50 people and 5 of them say this is great, and 45 of them say this is stupid. Why are you guys doing this? Why are you wasting my time? And so you're able to go back to the drawing board and kind of hack together a new hypothesis. But sadly, there's not often a magic bullet like with anything product led. You have to understand your customer. You have to really understand their product journey and their product experience. And this is where in PLG and especially in embedded scenarios with embedded lending, you have to be an expert in the core business and the core product, which is tough because not every finance person that would be joining a trade finance business like Flexport Capital might have logistics experience, right? And so there's a lot of learning and a lot of understanding the product and the customer that needs to take place to start becoming an expert in both things.
That's a really interesting point and something that is very topical. I just saw recently from SaaStr, Jason Lemkin was talking about how you hire a go-to-market team in vertical SaaS, given that there are a lot of generalist SaaS individuals out there. But to your point, if you are in a particular vertical and then you layer in lending, which is even more complex, how do you develop a team or the skill set of a team to ensure that you're speaking the language of the people that you're talking to and not just being generic around, here's a loan?
Some of it you can definitely solve for by cherry picking or at least looking for the right transferable experience. But from from my experience in my time, that's very hard, and you might start to get uh, very, very biased and kind of siloed points of view. Historically, what I've looked for when hiring folks is really people with a passion and a propensity to learn. And my coaching, my philosophy has always been treat every customer like a case study. If you're getting a look at their financials, if you're really understanding the ins and outs of their business, go beyond just a point solution or the vertical software where you're making an impact and really understand their business as widely and broadly as you can to then understand what are the implications that having access to extended credit terms and the flow of trade has on their supply chain and their margin and the bottom line and all of these different things when you're talking to now a CFO and a COO in a single sales call. And so really, yeah, looking for people with either that experience or being able to kind of suss out and solve for a lot of those characteristics, you start to find rock stars that are just really excited about learning something new and becoming an expert in a variety of domains as opposed to just being siloed into a single vertical and not wanting to learn anything else.
That makes sense. Shifting gears a little bit around what it takes to break into a saturated market. So, your time at Wells Fargo, I'm sure they thought their line of credit product to merchants was the best thing since sliced bread. But in reality, it's more or less commoditized, the same as every other bank out there. And so, whether you're a fintech or an embedded lender, you are offering more or less the same term and the same policies across the board. And so many of these companies try to differentiate by just really being marketing companies. If you think about even all the debit card companies out there, they're all the same product. They just market to different individuals, and everything kind of converges back to starting off in a small TAM and wanting to expand to being one product for everyone, which is where many banks have not been positioned to win against some of the more up and comers that understand their customers and their data better. And so, if you think about commoditized products across the board, what is it that actually differentiates based on your experience? Let's take the AP market, where when you were at Settle, you were competing against Bill.com, which is much bigger. And so, what did you do to set yourself apart more than just nice to have landing pages or really beautiful design forms, but actually in the product itself?
So this was a big, big collaboration and driven by our product team to really understand who our ICP is, right? It's hard to be everything to everyone. And if that's what you try to do, especially in the lending world, lending is commoditized, money is fungible. A dollar is a dollar, and whoever can get it to you the cheapest, the fastest, or will take on the most risk to capture the long tail. Historically, and kind of what I call fintech 1.0, those were the people that were getting ahead, but it becomes a very fast race to the bottom. And so at Settle, a lot of our time spent was really understanding our ideal customer and our target market, which was ecom brands, CPG brands. What do they do from a daily workflow? What do they hate about their current incumbent solution, which is whether it's Bill.com or something else, or maybe nothing at all? And how do we solve for those problems? And in the flow of that and in that scope, how do we improve their business and their ability to grow or leverage capital as a part of that experience versus really taking on the lending first approach and saying, hey, we're going to be a lender with this other product as an afterthought, because that's a quick race to the bottom. And with money being fungible, from my experience, one thing that people don't think about as much is retention, right? And every time somebody needs money, a prudent and a diligent business owner or CFO, they're going to shop you, right? Who's got the best deal? Who's going to give me the best term or the cheapest rate at that point in time? And so you might be churning customers after a single draw or after a month and spending a lot of time and effort and dollars into reacquiring them. And so the best thing you can do is give them the best product for your target market and continue to improve upon that and focus a lot on retention, because then you can start to deploy more capital, take on more risk, and really start to build a flywheel around that versus really getting sucked into that commoditized game of trying to outspend or out-risk everybody else and hoping that you're somehow special and different and you're not going to be a part of that race to the bottom.
It does seem that retention is one of the best value props to vertical SaaS companies that are looking to get into lending, right? They don't want to just have a transactional relationship with their customer. They actually want to have engagement. And the majority of that engagement happens in the servicing layer, right? You underwrite somebody up front, and then all of the interactions, repayments, restructuring, 90% of that happens in the servicing layer. And so what would be your advice to a vertical SaaS company thinking about getting into lending? Is there a moment in time that you think it is that they're mature enough, or that they have a particular pain point or problem that says it's now time to not expand the types of products we have in the industry, but instead actually get into financing on our existing core product type? So, again, Flexport as an example, in the supply chain and logistics space, makes a lot of sense for them to say, okay, we understand the overall data and timeline of shipping goods from Asia to New York. It's around 90 days. A merchant cash advance product makes a ton of sense, so that we can give our suppliers and their merchants working capital to continue to scale their businesses. It seems like a no-brainer. Many other businesses, though, might have a little bit of agita actually getting into this, because it seems like you're building a new mountain to climb internally, and you don't want it to be a distraction to your core product. So what advice would you have to someone in healthcare or logistics, e-commerce, travel, pick any vertical, that is thinking about getting into embedded lending?
First and foremost, talk to your customers. Make sure that you're really solving the core problem that you set out to solve for them. So if it's in the world of Flexport, we knew we were doing a good job solving the logistics problem and really delighting our customers with the experience they were getting from the solution, the service, anything and everything, and starting to ask them questions. What else keeps you up at night? What's the next problem in your business that's equal or greater, whether it's the same org or in the business more broadly, that you're needing to or wanting to solve or constantly really battling with or thinking about? At Flexport, it was a bit natural because trade finance is part of the scope of trade. But I think in almost every vertical SaaS business, if you're solving the core problem and talking to your customers and then starting to ask them what's the next problem, or even asking them point blank and saying, hey, if we could give you a financing solution that would be a part of this workflow and address a working capital problem or a liquidity problem that you have, how do you feel about that? And I'm willing to bet that if you're solving that core problem and your customers love you, they're going to give you a resounding yes, or at least very clear direction on what they would want to see. And from there, the next thing you really have to ask yourself is, do I have a unique advantage to be able to do this and do this well? Whether it's a data advantage, which again, I'm willing to bet that most vertical SaaS providers will have a unique data advantage. They just need to figure out exactly what it is. And then from there, really figuring out how do we optimize distribution. We already have a happy captive audience. We've got a unique view and understanding of these customers in a way that everybody else doesn't. How do we get the right product in front of them in the right way where it's going to have a compounding benefit for them and not seem like an afterthought and an add-on? And if you can answer those first two questions, then in my mind, that becomes a very clear time, because you're building on product market fit. You're not going to have a massive distraction from still figuring out product market fit and really derailing the core business, because it becomes a really hard thing to come back from, especially once you have a lending product out in the wild. Customers are depending on you for access to some capital. And if you decide to shut it down, that's going to have very real world implications to folks in their business, and might do more harm than good than if you wait an extra 6 months, get product market fit in the core, and then revisit the idea and ask the customers the same questions again.
Love that. To wrap up here, speed matters for any company, and the velocity at which you ship is a big indication of your overall trajectory, but so is your learning velocity. And so every company that you've gone through, I'm sure, has run into a few brick walls, and it's about what you learn from those moments and move forward. So what advice would you have to either your younger self or a revenue or go-to-market team just getting off the ground that's launching and shipping their first lending product? Maybe some of the pitfalls they could avoid based on some of the scars that you have gone through.
Measure twice, cut once. And really what I mean by that, and shameless plug for one of the Canopy products that I've poked around in and saw, the Loan Lab. Go to market in lending needs to be in very, very tight sync with product, and especially risk. If you have your own go to market hypothesis in terms of the customers you want to acquire, because that's the ideal target market, but they don't convert from a credit approval standpoint, you're going to run into a lot of heartache very quickly. And then really turning that cruise ship takes a lot more time and effort than you would think. It's much harder than if you're just changing AdWords or something else from a targeting perspective. You really need to start rethinking who's our ICP, who's going to get credit approved. And so really being in sync with credit, modeling things out to the best of your ability. And again, the Loan Lab product is really cool because you have the ability to actually test hypotheses without having real world implications, and before you can set them in motion. And then from there, once you get going, really having a very tight measurable feedback loop of, are these the right customers? Are they getting in funnel? And are we actually getting them approved? Because lending is one of the only products out there where if somebody really wants to buy your product, that doesn't necessarily mean that you're going to be able to give it to them if they're not credit worthy. And a lot of folks have to remember that, because it's very different from pretty much anything else, SaaS especially, where folks have budget, they have intent, they're going to sign a contract as long as you send it to them. And so, yeah, measure twice, cut once, and then make sure that you're keeping an eye and really measuring everything from that point forward.
Fantastic advice. I love that, particularly around the point that someone may want your product, but you may not be able to give it to them. And that makes lending very, very unique, as well as the fact that it isn't transactional like an AdWords click. Time and all of the potential scenarios that can happen as time moves forward, the future, or refunds, chargebacks, things happen in the past, make lending very multidimensional and challenging. So I think that advice is spot on. I completely agree with it. So we're going to wrap up here. Thank you so much, Aleks Flom, for joining us on our first Fireside chat. We'll talk with you soon. Cheers.